Have you just started earning and want to make sure you are making the right choices? Well then, you are in the right place. Welcome to the Foundation Years, a Beyond Piggy Bank series. I'm George, and in each episode we explore simple, practical ways to build your financial foundation before life gets more complicated. You don't need a financial degree and you don't need a lot of money to begin. You just need the right decisions made early enough to matter. Let's set the foundation. In the last episode, we set the stage. You are either building on something that was handed over to you or building it from zero. Either way, you are at the starting line. Today, we look at the first number that actually matters. Not the salary you were offered, but the salary that lands in your account. Because there is a difference. And most people never look at it closely enough. Your first payslip arrives. You look at the gross number, the one in the job offer, the one you told your family about. Then you look at what actually hit your bank account. And you think, wait, where did the rest go? That is the moment most people realize something obvious but overlooked. Your salary is not what you earn. Your salary is what you keep. In some countries, the difference is brutal. In others, it is less brutal. But almost everywhere, something is taken before you even see it. And if you happen to live in one of those rare places with zero income tax, like the UAE or the Bahamas or Monaco, consider yourself lucky. And feel free to skip ahead. For the rest of us, let's talk. Let me be specific about what is taking money before it reaches you. First is income tax, and this one is obvious, but the amount varies widely by country. In some places you pay 20%, in others you pay 45%. And it depends on where you live, how much you earn, and sometimes family status. The system basically is different everywhere. Second, social security contributions, pension, unemployment insurance. These come out automatically, and here is something worth knowing. In some countries, income tax is not deducted monthly either. It does not appear on your payslip. But that does not mean you do not owe it. It just means that the bill will arrive later, and later as a way of surprising people. And third, and less common, is union fees if you are in a union, professional associations, student loans. So the question becomes, what is actually yours? Let me give you an example. Say you are offered a gross salary of 40,000 a year. That sounds solid, that sounds like real money. But let's walk through what actually lands. Income tax, 8,000, 20% out. Social contributions, 4,800, that it's another 12%. Pension contributions, 2,000, 5%. Health insurance, if applicable, 1.2k, that is 3%. Total taken, 16,000. What actually lands, 24,000. You were offered 40,000, you are keeping 24,000. That's a 40% difference. Like I mentioned before, in some countries the gap is brutal, in others is smaller. But do not treat that as unfair without understanding what it buys. Higher taxes tend to mean healthcare is covered, education is covered, the safety net is real. Lower taxes mean more lands in your pockets, but health insurance, for example, becomes your own private bill, mandatory, just collected differently. The total cost is more similar than people think. What changes is who sends the invoice. Either way, your gross and your nets are different animals. Know the difference. Plan around the real number. Now, I need to say something clearly. Every country does it differently. I cannot give you the exact number for where you live, but I can give you the framework. And two things worth understanding that almost nobody explains. Let me use Switzerland as an example because it's where I am. Income tax for many people in Switzerland, nothing is deducted monthly at all. The bill comes at the end of the year. Which brings me to the first important point. In many countries, Switzerland in certain cases, Portugal, Spain, and others, tax is withheld from your salary every month. You see a deduction on your payslip. But here is what most people do not realize. That withheld amount is not a real final number. This is just the tax office best guess at what you will owe divided by 12. At the end of the year, when you submit your tax return, you declare your deductions. The real calculation happens, and then you either get money back or you owe more. The monthly deduction is an estimate, not a verdict. Here is what matters. You need to know your number, not the average, not what your friend told you, your number. Go to your payslip, look at the gross, look at what landed, write down every line, every deduction, every percentage. Then ask yourself, do I know what each one is? If the answer is no, go and find out. Call your HR department, check the government websites, ask someone who works in accounting. Because everything we build in this series depends on knowing what you actually have to work with. Not the number that sounds good, the number that it's real. Okay, so now you know what lands. Let's talk about what leaves after that. Your salary hits your account. Good. Now the real money leaves. Rent. Or if you are living at home, maybe you are contributing to your parents. Maybe not. Either way, housing costs something, directly or indirectly. Utilities, internet, phone, food, transport, insurance, subscriptions you forgot you had, clothing, haircuts, things that seem small until you add them up. And here is the invisible one, the money that leaves you and you do not even notice. Coffee, lunch at work, small purchases, rounding up, tipping. These are not big individually, but together they are a leak. So the picture now looks like this. Gross salary minus taxes and contributions equals net salary. Net salary minus expenses equals, well, what is left. What is left, that is where your future lives. And most people never calculate this properly. They get paid, money comes in, money goes out, and they wonder where it all went. Sounds familiar? This is not about blame, this is about visibility. You cannot fix what you cannot see. And most people are invisible to themselves when it comes to money. So here's the first foundational habit. It's not glamorous, not excited, but it changes a lot. It happens in two phases. Phase 1, you track everything for 2 or 3 months. Not 1 month, 2 or 3. Every single expense. Write it down. Use an app. Use a spreadsheet. However you want to do it, just make it visible. 1 month is not enough because 1 month lies to you. 1 month might be unusually quiet or unusually expensive. 2 to 3 months starts to show you the real pattern. What comes in consistently, what goes out consistently. Rent, food, transport, subscriptions, the baseline of your life. At the end of phase 1, you will see 3 things. Your actually net salary, not the gross, the real number. Your actual monthly expenses, every category, nothing hidden, and the gap, what is left. That gap is your starting point for everything else. But phase 1 only tells you half the story. The other half is the annual layer, which is phase 2. Go back through 12 months of bank statements and look for everything that does not show up every month. Car insurance paid once a year, but it's still a monthly cost. You just do not feel it that way. Health insurance paid quarterly, annual subscriptions, the holiday, the birthday gifts, the tax bill if your country does not withhold at source. These are real expenses. They just do not announce themselves regularly. And because they are invisible in phase 1, people forget to plan for them. Then they arrive, and suddenly the month is broken. The habit is this: find them, add them up, divide by 12. Now you know what they actually cost you per month. Add that to your phase 1 baseline, and that is your real number. Now, a note for those of you who have not been earning for a full year yet. You may not have 12-month statements to look at. That is fine. Start phase 1 now, track the next 2 to 3 months properly, and set a reminder for 12 months from today to go back and do phase 2. The pattern will reveal itself. You just need to give it time. Because right now, without this, you are making financial decisions blind. You do not know what you have. You do not know where it goes. And you are trying to build something on a foundation of guesses. That does not work. Once you have the full picture, phase 1 and phase 2 combined, that is when real decisions become possible. Which expenses are actually making your life better? Which ones are just habits? A subscription you never use, a quarterly bill you always forget it's coming, an annual cost you could reduce if you just looked at it once a year. These are not moral failures. They are just choices nobody asked you to examine. Once you examine them, you can make different ones. And that is where the real money appears. Not from earning more, from keeping more of what you earn. Visibility, then choice. There is something else worth knowing. The way your salary is structured, gross, taxes, contributions, that is set by law. You do not get to change it. But the way you spend what is left, that is entirely your choice. And here's the thing about choices. Small choices made consistently compound. Saving an extra $150 a month does not feel much. Over a year, it's $1,800. Over 10 years, even with modest returns, it grows to around $26,000. Not because of magic, because of time and consistency. If you want to understand exactly how that works, episode 3 of Baby to Graduation series breaks it down completely. But it only works if you see the opportunity in the first place. And you cannot see it if you do not know what you have. This is why this episode comes first. Not because earning more is not important. Of course it is. But you cannot optimize what you do not measure, and you cannot measure if you are not looking. In the next episode, we talk about the emergency fund, the thing that sits between your salary and the rest of your life, the buffer that protects you when things go wrong. Because they always do eventually, and you need to be ready. But first, do the work on this episode. Track your salary, track your expenses, know your number. Everything else depends on it. I'm George. This is the Foundation Years, a Beyond Piggy Bank series. You now have the first number that actually matters. What lands in your account, what leaves immediately, and what is actually yours to work with. That is the foundation. That is where decisions come from. Let's set the foundation.